Hello, I'm Alexander Fitzalan. I've been at JPMorgan since 1986. I've been running European equity portfolios since 1999, and I've been involved with the JPMorgan European Growth and Income Trust since the early 2000s.
Hi, my name is Zenah Shuhaiber. I joined JPMorgan in 2005 and joined investment teams in 2007, managing multi-regional portfolios. I joined this investment trust co-managing with Alexander in 2020.
The JPMorgan European Growth and Income Trust goes all the way back to 1929, when it started life as the London and Holyrood Trust. It's been invested in European equities since 1988. In 2006, it split into two separate portfolios, an income share portfolio and a growth or core share portfolio. But the interesting thing is that in February last year, the two portfolios have merged. Going forward, it will be run on the same basis as the growth or core leg, but, and this is the exciting bit, the board have decided to pay a 4% annual dividend. So this means that we can use the investment trust structure to pay that dividend without compromising the investment strategy of the core portfolio. In order to do this, we want to invest in a core, balanced portfolio that can generate incremental returns through different market cycles and in different market conditions. To do this, we're looking for companies that are high quality, are cheaper than the market, and have better operational momentum than the market. When we're looking at a company, we're looking for various attributes. First of all, we want to invest in quality businesses. And for us, that means companies that generate a good return on invested capital, companies where earnings per share translates into free cash flow, and companies where we think the management are making sensible capital allocation decisions. In terms of valuation, it's important for us to work out whether the market has already discounted those prospects or whether there's an opportunity still to make money. And lastly, in terms of momentum, it's really important that the company's operational momentum is improving. And one way of looking at that is to see whether earnings per share estimates are rising or being cut back. Not all companies that we invest in will have all those attributes, but overall the portfolio as a whole will always be cheaper than the market, will always have better quality than the market, and better momentum characteristics. I think it's worth saying also that because we are overweight both value and growth within the portfolio, that has been really helpful to performance over the last few years.
We think that European equities is a very important asset class and one to not be forgotten. The market definitely corrected last year, with European markets down around 9% in sterling terms, amidst a lot of bad news that happened within Europe. But we need to remember a couple key points in terms of European companies. The first one being that they're very global in nature. When we look at our portfolio, for instance, only around a third of the revenues streams actually come from continental Europe, meaning that the companies within the European universe are far more linked towards what's happening in the global economy rather than just simply continental Europe. The second one being how well they play into longer-term themes and really exciting themes that we can all think of that are leading the future in the years to come. So for instance, the energy transition, or when we're thinking about the luxury consumer, or even aging demographics. So while we don't think that all the bad news is necessarily out when we think about the macro situation within Europe, we definitely think that the right time to start looking at Europe is before that, because markets tend to bottom well before the bad news is out. We think of three key features that distinguish JPMorgan European Growth and Income Trust. The first one being the investment process. It's a very disciplined investment process that goes back many, many years. When we think about how we achieve the returns that we achieve, we really rest on sort of two key pillars within JPMorgan and really utilize the full breadth of what we have within our quantitative research capabilities as well as our fundamental research capabilities. And by doing that, deliver a core portfolio that is diversified by both stock as well as style. The second one being the track record. The track record is very long term. We have outperformed in the most recent years, which is great news. But even when we think about the long-term performance of the investment trust, we have also demonstrated our ability to outperform in a variety of different market environments, be it value markets, growth markets, or even up and down markets. And then finally, the third one is the dividend. This makes it a very resilient and reliable source of income for our key investors. When we look at stock selection, we really think of asking ourselves 4 key questions. The first one being, is it a good business? And by this, what we're thinking of is thinking about things like profitability. We look at measures like return on invested capital. We also think about how variable those earnings and cash flows are over time, and whether the management team are making good decisions in terms of capital allocation for things like mergers and acquisitions or further CapEx. The second question we ask is the company attractively valued? Valuation is incredibly important and has been so for many, many years. It had been a little bit forgotten in the last couple years, or the last decade or so, as investors focused a lot more on growth. But for us, maintaining that discipline has been very helpful, in particular in 2022, as we think that focusing on measures such as price to earnings and free cash flow yield is really powerful over the longer term. The third question we ask ourselves is the momentum improving? And by this, we're looking at both operational momentum as well as just simply the share price momentum. We think that companies that are doing well will continue to do well in the future, and the converse of that is also true. And then finally, the fourth question is the business sustainable? Now, this has been a really key issue in the last few years, and it's definitely part of our investment process. And we look at it again, as we do for the other 3 questions, in both thinking about quantitative approaches and qualitative approaches in terms of assessing whether a business is sustainable. And really what we're trying to ascertain here is this an opportunity? Is this a risk? Or is this something that we can consider engaging with company management in terms of assessing whether this is a good investment opportunity for us? When we look at our longer-term track record, we can see that we have outperformed in both value and growth markets. We have also outperformed in both up and down markets. In terms of thinking about the actual dividend that our investors receive, that dividend yield is set at the very beginning of the fiscal year, meaning that that is a very reliable and known amount of income for the course of the year. When we think about how do we deal with macro issues from a portfolio manager perspective, we actually try to not get too bogged down with everything. As fund managers, we need to know what we are good at, for instance, the stock selection piece, versus the many different kinds of risks that we might experience throughout the course of the year.
We are still quite defensively positioned, but much less so than, say, 6 months ago. Last year, many of the defensive companies within the market, and I'm thinking the pharmaceutical sector, for example, or consumer staples companies, food and beverage companies, that sort of thing, performed really well. But as a result, many of them are now quite expensive. In contrast, on the cyclical side, a lot of those companies did not perform so well and have really become quite cheap. We've started to add some money to that area, particularly where earnings have held up well on the cyclical side. One example is the semiconductor space, where demand for semiconductors is growing exponentially, for example, through the growth in electric vehicles, which use many, many more semiconductors. So gradually, we're beginning to become a little bit more cyclical and a little bit less defensive. I think the combination of the correction in the market post-COVID and the big recovery in earnings since COVID means that the market is now trading on very low valuations. It's currently on just under 13 times this year's earnings, which if you look back historically is an attractive level. If you compare it with the US market as well, you have to go back a long way before you can see the European equity market trading so cheaply. So yes, I think that investors ought to be looking at European equities again.
The JPMorgan Growth and Income Trust is ESG integrated, which means that we consider ESG issues throughout the investment process. When we're looking at a stock, for instance, we're really thinking about incorporating sustainable investing into, just as we do for any of the other metrics that we're looking at. And so we think about both quantitative metrics as well as fundamental metrics to look into what are these issues that these companies are facing. So an example of a quantitative metric could be something as simple as the carbon intensity of a business. On the fundamental side, our research analysts answer a 40 questionnaire and answer things such as what are the processes in place in terms of data security for a company, and are those processes effective? Or what is the credibility of a company management in terms of reducing their carbon emissions? So when we think about these questions, it's not necessarily a simple yes or no, we won't invest in them. It really is just that starting point in terms of how do we now engage with company management in terms of turning this around and really understanding these issues a lot more and helping us understand the investment case from then on forward.